In our final segment of the chapter, we'll discuss the simple rate of return. This one is left for the end because the simple rate of return is the only opportunity that we talked about, or the only method for analyzing long-term investments that doesn't focus on cash flows. Instead, it focuses on the net operating income. So it doesn't focus on cash flows, it focuses on the net operating income, and we use the following formula: annual incremental net operating income over the initial investment. For our purposes, this annual incremental net operating income would be really our net annual cash flow minus depreciation expense. Depreciation expense, you may remember back to our budgeting chapter, is a non-cash expense. So to convert from cash flows to net income, we can take out our non-cash expenses, depreciation expense. The initial investment is reduced by any salvage value from the sale of old equipment. So in other words, if I make an investment of $100,000 for new equipment, but I'll get 10 grand back when I sell the old equipment, then the amount of the initial investment is the net amount, which we'd put in for cash flow zero, of negative $90,000. In this case, you don't put in the negative, you just put in the $90,000. So management at Daily Grind wants to install an espresso bar in its restaurant that costs $140 and has a 10-year life. It's generating incremental revenues of $100 and incremental expenses of $65. So what's the simple rate of return? So all we do is figure out first our net operating income, which would be the difference between the 100 and the 65, which is $35,000, and we divide that by the initial investment of $140. And here you can see that the simple rate of return would be 25%. Now keep in mind that the simple rate of return doesn't account for time value of money at all, so it's not nearly as accurate as internal rate of return. This would be a good way to screen an investment decision to decide if we want to look into it further. If our simple rate of return is greater than the minimum, we would look into it further. If our simple rate of return is less than the minimum return, we wouldn't. So again, the shortcomings are that it ignores time value of money, and the same project may appear desirable in some years and undesirable in others because, of course, the operating income may fluctuate from year to year. When an investment center manager is evaluated using ROI, a project's simple rate of return may motivate them to bypass investment opportunities that earn positive net present values. So this is kind of like that idea that if you're evaluated based on ROI, you may decide to reject investment opportunities that actually earn more than the minimum return. So effectively, our ROI is very similar to simple rate of return, and net present value is very similar to residual income, except net present value also accounts for time value of money. So if we want to make sure the investment manager is accepting all opportunities that earn greater than the minimum, we want to evaluate them based on NPV as opposed to simple rate of return. A post-audit is extremely important for all these long-term projects. The goal of a post-audit is going to be to determine whether our predictions for those future cash flows were in line with reality. So it basically is a way we can test whether our assessment of investment opportunities is reasonable or not. We can't just assume that we were right. We want to do a post-audit to determine that our assumptions were in fact in line with reality. And if they're not, we could figure out what the flaws were so we can then improve moving forward. And there you have it. Not only is this the end of chapter 14, but it is the end of our final chapter together. So as always, please use the resources that are available on Canvas to get ready for the final exam, including practice problems and practice exam questions that'll be available. Further, use the additional resources on Connect to further develop your understanding of the material. Reach out on the discussion board with any questions, and practice, 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 and when you can't take it anymore, do a little more to make sure you're ready.